Hello, and thank you for joining us in this webinar. My name is Stephanie, and I'm here today to help you to understand what your options are with respect to your pension after a job loss. Our agenda today covers general information about job loss and break-in service. It also breaks down your pension options depending on your age. It's a lot of information, so if you have questions, please jot them down so you don't forget to ask them at the end of the presentation, when we'll have time to answer questions. Your pension benefit is meant to provide you with a lifetime pension in retirement, so the longer you participate, the greater your pension is. When you are laid off, contributions to your pension are no longer made, so in this webinar, we'll go over your options. If you have any further questions following this presentation and our Q&A session, we encourage you to contact a pension specialist at the plan office who will be happy to assist you. We also recommend that you speak to an independent financial advisor to help you make the best decision for you. How it works is that you break service with the plan when you do not work at least 350 covered hours in 2 consecutive calendar years with a participating employer. When this happens, all credited service you have earned changes from active service to deferred service, and you become a deferred plan member. Breaks in service are calculated on a calendar year basis on December 31st. This first example on the screen shows you would break service on December 31st, 2025, if you accumulate 200 covered hours in 2024 and no hours in 2025. Following this break in service, the plan office would send you a break in service package in March of 2026. The second example shows that the member remains active as at the end of 2025. They have a total of 700 covered hours in a 2 calendar year period. Depending on your age and your pension amount, after a break in service, your options will differ. It's important to note that if you've recently been laid off, you may not break service for some time. The types of hours in the plan for which you receive credited service are funded and unfunded hours. You and your employer both pay contributions on funded hours. Some examples besides your working hours are leaves such as parental leave and jury duty leave. Unfunded hours are those for which you and your employer do not pay contributions, but which you still receive credited service for. Examples are layoff and disability hours. Excess hours can only be used to bring you up to a full year of service in the years you don't reach the hours threshold applicable to those years, including the year you retire. Excess hours cannot be used to prevent a break in service. We'll go into the excess hours and how they can be used later in this presentation. Involuntary job loss is when you lose your job due to economic or environmental factors such as downsizing, technological change, or if your job is eliminated, or if your employer permanently closes its operation. There are provisions in the pension plan to help protect members' pensions after an involuntary job loss, which we'll explain in a moment. If you are 60 years of age or older, you can apply for your pension immediately and receive 100% of your pension benefit. You also have the option to defer your retirement to maximize your excess hours prior to your break-in service date. Excess hours can be used to increase your credited service from the time you stop working to when you break service or retire. It's important to remember that you need to contact the plan office 3 months before you wish to start your pension. If you are an active member and have an involuntary job loss after reaching age 55, you will not break service from the plan and will remain an active member. You will be entitled to the subsidized early retirement benefit beginning at age 55 and will be able to receive 100% of your pension if you retire at age 60. Please note, to qualify for this provision, you must be age 55 on the date of the involuntary job loss. With the subsidized early retirement benefit, you can see that between the age of 55 and 60, you would be receiving between 82% and 100% of your pension based on your age and status. Other factors, such as the pension option you choose and whether or not you have a spouse or beneficiary, will affect the amount you receive. At the age of 60, you would be able to receive 100% of your pension. Please remember that you need to contact the plan office 3 months before you wish to start your pension. You may also use any excess hours you have accrued so that you can continue to accrue credited service until the date all your excess hours have been used, or the date you choose to retire, or your 65th birthday, whichever comes first. Here's how it works. This member is not returning to work for a participating employer. He is 56 years old and has 20 years of credited service with 9,000 excess hours at the end of 2022. Without the IGL provision, he would break service December 31st, 2024, and can only use a maximum of 3,600 excess hours towards his pension. However, in the second example with the IGL provision, you can see by choosing to retire at age 61, he's increased his credited service to 25 years by using his 9,000 excess hours and increased his pension in retirement. We encourage you to contact the pension team to see if this applies to your specific situation. If you're under age 55 when you break service, you have a few options, depending on whether or not you return to work with a participating employer after breaking service because of the involuntary job loss. There are over 400 participating employers in the plan. If you find other work in the industry with a participating employer within 2 years, you will remain active in the plan. Staying in the plan allows you to continue to build your lifetime pension in retirement. Active service also qualifies for the subsidized early retirement benefit, and you may be eligible for future plan improvements. If you return to work for a participating employer, you may be eligible to upgrade the status of your credited service from deferred service back to active service. If you do not return to work with a participating employer, all credited service earned leading up to the break-in service date changes from active service to deferred service, and you become a deferred plan member. We'll go over these two scenarios in more detail now. If you return to work with a participating employer within 3 years of your break-in service, you may qualify for the deferred service upgrade, which was formerly called the 2-for-1. To be eligible for the service upgrade, you must satisfy all of the conditions listed here. As shown on the previous slide, you need to return to work for a participating employer within 3 years of your break-in service. For each full year you work, you can upgrade 2 years of deferred service. Here's an example. At the time of the break-in service, this member had 15 years of deferred service, which you can see on the left. They returned to work for a participating employer and worked 4 full years. Because they satisfied all of the conditions, they can upgrade 8 years of deferred service to active service. Now they have 12 years of active service, and their deferred service has reduced to 7 years, which is shown on the right. The total number of their credited service earned prior to the break-in service doesn't change, only the status of their credited service. By continuing to work full years of service, your total deferred service will decrease and your total active service will increase. If you are under age 55 when you break service with the plan, all credited service earned leading up to the break-in service date changes from active service to deferred service, and you become a deferred plan member. You have 2 options: leave your pension in the plan and receive a monthly pension when you retire, or, following your break-in service, receive a termination lump sum payout, and end your membership in the plan. You are entitled to a lifetime pension at the normal retirement age of 65, or you can take a reduced pension as early as age 55. Keeping your benefit in the plan has its advantages. When you receive a pension for your lifetime, you won't risk outliving your benefits, and you can count on receiving the same pension income every month. If you return to work for a participating employer, you will continue to build your pension and may be eligible for future negotiated improvements and benefit upgrades. And at retirement, you will have the option of providing coverage for your spouse or beneficiary, so they are financially protected should they outlive you. If you die before you start to collect your pension, your surviving spouse, beneficiary, or estate will also receive a benefit from the plan. If you choose not to receive a pension from the plan in retirement, you may choose to transfer your lump sum benefit out of the plan. It's important to remember that if you choose this option, you no longer qualify for the involuntary job loss provision, and you will no longer be considered a plan member. This means you will not be eligible to receive any future pension improvements or post-retirement benefit increases. In addition, your spouse or beneficiary will not be eligible to receive a benefit from the plan after your death. If you choose to leave the plan, your lump sum benefit is calculated as the amount of money that, if invested today and held until you were 65 years old, would be expected to provide you the same monthly pension that you are entitled to receive from the plan in retirement. If your lump sum benefit is over the legislated threshold of $13,320, it is considered locked in until you reach age 55. It can be transferred out of the plan, but only into another locked-in retirement vehicle. This legislated threshold changes annually. There are several payment options and legislative provisions that may apply to how your benefit is paid. You can obtain this information by contacting the plan office. If you are receiving a long-term disability benefit from the IWA Forest Industry Ltd plan and are considered totally and permanently disabled, your pension is protected by the involuntary job loss provision. With the involuntary job loss provision, you are considered an active member and can retire as early as age 60 with 100% of your pension. You will continue to receive disability credits while on LTD. You will not break service, and your pension will continue to grow. All pensions are payable for your lifetime. The difference is in the beneficiary coverage. Your options after a job loss differ according to your age. If you are age 60 or over, you can immediately apply to receive your pension without any age reductions or delay your pension until you break service, optimizing the use of any excess hours you may have. As an active member between the ages of 55 and 59, you can receive a subsidized early retirement pension, or wait until you are 60 and collect an unreduced pension, or delay your retirement further to utilize more of your excess hours. If you are 55 or under, you can receive your pension when you break service or reach retirement age, whichever comes first. If you retire early, you can receive the actuarial equivalent based on your age. You can also receive a termination lump sum payout and end your membership in the plan. Please note, you need to be under the age of 55 at the time of your break in service. The normal age of retirement for this plan is 65. You have the option, however, to retire as early as age 55. All active members are entitled to the subsidized early retirement benefit. If you are an active member between the ages of 55 and 65, you are eligible to receive between 82 and 100% of your pension for the remainder of your retirement. See the left side of this illustration. If you are a deferred member, you have the option of receiving 100% of your pension from the plan beginning at age 65, or an actuarially reduced pension as early as age 55. The reduced payment is due to the fact that you are collecting your pension for a longer period of time. See the right side of this illustration. Deferred members over age 65 should apply immediately, as the pension amount does not increase and the pension start date cannot be backdated. According to legislation, the latest date you can retire is December 1st of the year you turn age 71. Continuing to work past age 71 will not impact your pension. While the illustration above shows the percentage you will qualify based on your age and status, other factors, such as the option you choose and whether or not you have a spouse or beneficiary, will affect the amount you receive. When you apply for your pension, there are several options for you to choose from. The option you choose and whether or not you have a spouse or beneficiary will affect the amount you receive. The greater the spousal coverage you choose, the lower your monthly pension payments will be. This is because your pension payments will need to cover your lifetime and the lifetime of your spouse. Should your spouse decide to waive their legal right to a lifetime survivor benefit coverage, they will need to sign a waiver. If you do not have a spouse, or if your spouse waives the survivor benefit, you may designate who will receive the death benefit. You may designate more than one person. For example, you can name your children as beneficiaries. If you do not have a spouse or beneficiary, you can select the straight life option. In a nutshell, here are the three basic types of pension options. There are a few joint and survivor options which provide lifetime coverage for both you and your spouse, should your spouse outlive you. The guaranteed options provide lifetime coverage for you and may provide limited coverage for your spouse or beneficiaries based on the guaranteed date. The straight life option is only payable for your lifetime and does not provide any beneficiary coverage. With these options, there are a few sub-options, which we'll describe in more detail next. The joint survivor option is only available for members who have a spouse. If you do not have a spouse, you cannot select this option. With this option, your spouse will continue to receive a monthly pension after your death. If your spouse dies before you, there will be no further payments from the plan following your death. It's important to note that if you choose the joint survivor option and then divorce or separate from your spouse, you cannot change your beneficiary. This joint and survivor option also offers a 10-year guarantee. As soon as you receive your first pension payment, the clock starts ticking on the 10-year guarantee period. In this case, if you die before the 10-year guarantee period ends, your spouse will receive monthly payments equal to 100% of your lifetime pension for the remainder of the guarantee period. When the guarantee period ends, your spouse's monthly pension payment will be reduced to 60% of your lifetime pension. With the guaranteed options, you receive your monthly pension for your lifetime, with a guaranteed option for a period of time which you select. If your named beneficiary passes away before the guaranteed period expires, you must elect another beneficiary. If you both pass away at the same time, say as a result of an accident, we would pay the remaining payments of that guaranteed period to your estate. The most important thing to remember with any of these guaranteed options is that if you pass away after the guaranteed period expires, no further benefits are payable. For example, if you select life with a 15-year guarantee and live for 20 years following your retirement date, nothing further is payable to your beneficiary or estate. The straight life option is just that. It's payable for as long as you live, but offers no beneficiary coverage whatsoever. If you pass away after receiving only one payment, nothing further will be payable to your estate or beneficiaries. It's important to note that you need to apply for your pension before you receive it. Your pension doesn't start automatically. At least 3 months before you wish to apply for your pension benefit, you should contact the plan office to request a retirement application package. When you let us know you are interested in retiring, we'll provide you with an estimate and an application package. Please remember that your pension is considered taxable income. We will withhold taxes based on the information provided on your TD1 tax form. The government provides additional retirement benefits, including the Canada Pension Plan, Old Age Security, and Guaranteed Income Supplement for individuals with a lower income. Speak to a Service Canada rep for more information and a full estimate of your combined monthly pension. If you have any questions specific to your situation or would like guidance on completing any forms, contact the plan office and we will be happy to help you. A reminder that we do not, however, provide any financial or legal advice. We encourage members to check our website out regularly for any updates and events like this one, to download pension and LTD forms, read annual reports, newsletters, and plan booklets. To learn more about your pension, take a look at our pension videos. These videos go into more depth about topics such as your pension options, applying for your pension, beneficiary coverage, earning service, and breaking service. Each video is only 2 to 3 minutes long and is full of great information. We do our best to provide accurate information, but not every rule or situation is covered. This presentation is not a substitute for the plan text, which is available by contacting the plan office. If there are any inconsistencies between this presentation and the plan text will always govern.